India and not China will drive growth in Asia in the years ahead. India will become the engine for entire Asian growth, fast outpacing and closing the gap on China. This bold prediction has been made by S&P Global Forecasts. The report titled China Slows, India Grows predicts that India will lead this charge with its GDP expected to grow to 7% by 2026. So, will India replace China as the world's factory anytime soon? And can India become the hub of a new global supply chain dealing from China? Economic growth in the Asia-Pacific region is expected to move from China to India and Southeast Asia, according to this report. Currently ranking third on the continent in terms of GDP after China and Japan, India seems ready to take up the reins of economic growth leadership. India's GDP is predicted to grow by 6.4% for the fiscal year ending March 24, up from the previous estimate of 6%, primarily due to higher domestic consumption. According to the report, balanced domestic consumption has helped India's economy withstand high food inflation and slower export growth. Other emerging markets in the region such as Indonesia, Malaysia and the Philippines are also anticipated to experience positive GDP growth. As China faces economic challenges, there are growing signs that its era of rapid growth may be coming to an end. Growth in China is expected to slow down from 5.4% in 2023 to 4.6% in 2024. S&P Global warns about challenges in China's real estate sector, highlighting the ongoing impact of low demand for new properties. However, this is not the only challenge that China faces. Geopolitical tensions add another layer of complexity. Decoupling or de-risking strategies are becoming more popular as investors worldwide become aware of the risks involved in investing in China. Companies are actively seeking alternatives with a clear preference for emerging Asian nations such as India and Vietnam. According to the latest reports, Apple manufacturer Foxconn intends to invest $1.5 billion in India. Tesla is also considering a $2 billion investment. These companies already have sizable factories in China. However, they are now focusing on diversifying their manufacturing to include India. With predictions of a 7% GDP growth in 2026, India is expected to grow at the fastest rate in the region, followed by Vietnam at 6.8%, the Philippines at 6.4%, and Indonesia staying stable at 5%, all outpacing the slowing Chinese economic growth. Do subscribe to our channel or hit the like button.